Hello, this is an estate and gift tax online module. We're talking about the annual exclusion, and in this set of materials we take up the present interest requirement. And I am Professor Donna Byrne at William Mitchell College of Law. Thanks for joining us. Now, let's just review a little bit. We already talked about the annual exclusion, and I want to remind us that we only need it if we have a completed gift, just so that we don't get taxed on all of that completed gift. If we don't have a completed gift, we don't care about this. Now, there goes Bruiser. I hope he doesn't bark too much. Section 2503B provided the annual exclusion. It's per donee per year. It started at $10,000 and now it gets inflation adjusted. We're up to $14,000. We saw that married couples can split their gifts, or an individual married person can double the gift with spouse's consent under Section 2513. And we saw that taxpayers try some clever ways of giving more than the annual exclusion and having it qualify. So now we are turning our attention to the present interest requirement. Not all gifts qualify for the annual exclusion. Again, we only need it if there's been a completed gift. I want that red language to sort of burn into everybody's brains. I can't overemphasize this. So here's the general rule from 2503B again. We saw this before, but now I've emphasized the material in parentheses. In the case of gifts, other than gifts of future interest in property. So we're carving out gifts of future interest. No annual exclusion if there's a future interest. So, what are we talking about? Well, a present interest, according to the Regs, is one that gives the recipient an unrestricted right to the immediate use, possession, or enjoyment of the property or the income from the property. So let's consider, first of all, what they mean by use, possession, enjoyment, or income. It depends on the kind of property. If the property is a house, I'm going to take myself out of here, then immediate use, possession, or enjoyment means the immediate right to live in it or to rent it out and get the rent from it. If it's a farm, it means the right to the crops that the farm produces, as well as occupying the farmhouse. If it's forest land, it's the right to harvest the timber and to do anything else on the land that we would normally do in forest land. If it's corporate stock, it's the right to get the dividends when they're paid out. If it's a bond, it's the right to receive the interest. Here, I think I can, here we go. So, the use or income from the underlying property has to begin immediately for this to be a present interest. Now, there are some assets that sort of by their nature pay later. For example, life insurance. Life insurance by its nature pays later. If I give my life insurance policy, the policy on me, to my son, if he receives all of the incidents of ownership, then that is a gift of a present interest, right? Even though it's not actually going to pay out until later. Another example, David sells his car and receives a note in return. The note says that the buyer is going to pay him on a regular basis, annually. He gives the note to his son. Now, even though there won't be a payment for a little while, that's okay. This is still a gift of a present interest if the son will be entitled to the income that accrues starting immediately. Where's the arrow? There we go. Okay, now let's talk about Hackle versus Commissioner from your casebook. Albert and Christine Hackle bought $4.5 million worth of tree farming properties and placed them in a limited liability company. This was kind of part of their retirement plan. They knew there would only be losses for some number of years, and that kind of makes sense, right? It takes a while for trees to grow, but then maybe later on there'd be retirement income. Now, Albert served as the manager for life. This was written into the LLC. The manager could control the distributions from the company, And anyone who wanted to sell his or her units in the company had to ask permission to do so. So, Albert and Christine gave units in TRICO to their children and grandchildren. So we're looking for annual exclusions, and that means we need to know if these are gifts of present interest or future interest. All right, so the LLC units were valuable. They gave them away, and that depleted Albert's and Christine's estates. Right? No consideration. So these are gifts. Were they gifts complete? Well, yes, because Albert and Christine could not take them back or change their terms. Right? So these are completed gifts. So we ask the question, were these gifts of present interest? Do the donees have an unrestricted right to immediate use, possession, or enjoyment of the property or the income from the property? Well, the court said there has to be some presently reachable economic benefit. But no income was accruing, right? We expect this property to turn a loss for a while. There was no right to withdraw money and no right to even sell the interest. In addition, a donee could not force a dissolution of the company in order to get to the assets. So the court cited a trust case, and we'll be spending a lot of time with trust, and said that in a trust, the donee has to show that there will be income, that some part of the income will flow steadily to the beneficiary, and the portion of income flowing to the beneficiary can be ascertained. Well, here, there's no income expected for some time. And when there is, it will not automatically flow to the donee. Why? Because remember, the manager had discretion about whether to distribute the income. That's fatal. There's no way to tell how much of it will flow to the donee. We don't know if any will. So the court held that there is no present interest on these facts. This is a gift of a future interest, no annual exclusions. Okay, so now let's talk about interest in trusts. Since the court raised that example, remember that when we transfer property into a trust, we have to analyze each interest separately. So usually with a trust, there's more than one gift. There's usually at least a gift of an income interest and a gift of remainder. And keep in mind, the test is, for present interest, there must be mandatory payments of income at least annually. The trust property must produce income, or be expected to, and the interest of each beneficiary must be ascertainable. Now, if these criteria are met, there is a present interest, and the annual exclusion applies. Clear? Super important. If there is no completed gift, we do not care about the annual exclusion. I've said it before, I'll keep saying it. Step 1, is there a gift? Step 2, is the gift complete? Step 3, is it a gift of a present interest? Do not skip the first 2 steps. That's like skipping breakfast. And there's the camel again. So this is the end of this video. Thank you for watching.